Hello and welcome back to the channel. Let's go back 20 years to the 2000s when the first iPod was launched and Apple had a market cap of approximately $4.8 billion. We were seeing articles such as this where investors were starting to question if Warren Buffett had lost his touch as he avoided investing in the trend of rising technology stocks. Does any of this sound familiar? Now we know that Berkshire managed to outperform while most speculators got slaughtered during the tech bubble. But I feel like a lot of people don't truly understand how much better the outperformance was. Over 20 years, from the 1st of January 2000 till 1st Jan 2020, an investment in Berkshire has returned approximately 520% compared to the Nasdaq index return of around 152% over the same period. Looking at these figures on an annualized basis, Berkshire has delivered a return that was more than double the Nasdaq on an average annual basis, 9.55% versus 4.75%. This is with dividends reinvested, by the way. A hypothetical investment of $10,000 would have grown to just over $62,000 with Berkshire and approximately $25,300 when you invested in the Nasdaq at that time. The point I'm trying to make here is that value investing makes sense. Buffett's goal for Berkshire Hathaway has been to make it a financial fortress that would be able to protect its shareholders irrespective of market conditions. Buffett has admitted that the strategy would underperform in a market with irrational exuberance, much like what we have seen in the financial markets over the last few years. Value investing actually is a timeless concept that focuses on cash flows and the durability of earnings that a business would reasonably generate for several years into the future and discounting that back at an appropriate discount rate. However, Berkshire Hathaway has gotten too large to capitalize on smaller opportunities and grow at higher rates, like it did for the past few decades. Now, this is where Bill Ackman and Pershing Square come in the picture. Bill Ackman rose to fame due to his publicly controversial position and feud with fellow activist investor Carl Icahn. Also, this year, Bill Ackman has been gaining a lot of traction in the media for executing what has been titled the best trade ever. A quick summary for those who aren't familiar with this best trade ever is that in March, Pershing Square had disclosed that they held credit default swaps, similar to what we heard about in 2008, to hedge on US investment grade and high yield credit indices and the European investment grade credit index. This hedge paid off as they were able to generate a payout of $2.7 billion on a payment of just $27 million. The gain had offset the losses in their equity portfolio experienced in March. Another reason Ackman was being featured in the news was for creating the largest special purpose acquisition company, or SPAC, called Pershing Square Tontine Holdings. If you want me to make a detailed video explaining the structure of Pershing Square Tontine Holdings, do let me know in the comments below. Now, this isn't the first time that Ackman has set up a SPAC. His previous attempt had been to bring Burger King into public markets, and that endeavor has compounded at roughly 15 to 18% since its inception. Bill Ackman has clearly stated that moving forward, his strategy would be to focus on businesses that he understands, so in his circle of competence, with strong cash flows and durable moats, and it's in a quintessentially value-focused methodology. Currently, his investment holding company that's structured as a closed-end fund, Pershing Square Holdings, is listed under the ticker PSH. The company manages a concentrated portfolio in the following companies: Lowe's, Restaurant Brands International, Chipotle Mexican Grill, Agilent Technologies, Hilton, Starbucks, Howard Hughes Corporation. The fund trades at a discount to the NAV, and in a recent interview with Bloomberg, Ackman stated that in his opinion, all the positions are undervalued and could continue to be long-term compounders. If you go through the annual report, you can find that Pershing Square also charges a management fee along with a performance fee that is subject to a high watermark. Now, the reason that Ackman opted to set up a closed-end fund is to set up a permanent capital base. In a traditional hedge fund structure, he was always exposed to the risk of redemptions from investors. With a closed-end fund structure, investors can opt in by buying shares of Pershing Square Holdings and sell the shares to another buyer whenever they wish to opt out of the fund. Now, in my opinion, betting on Ackman in 2020 for the next 20 years could be similar to an investor betting on Buffett back in 2000. Buffett was creative in his approach to using the float from his insurance business as leverage. Ackman is creative in his approach on using SPACs to generate value for his shareholders through activism. You can draw similarities between both portfolios since they're both focused on investing in companies with strong cash flows trading at reasonable prices that were in the circle of competence of the respective managers and relatively unrelated to whatever the trending stocks were at that particular time. Do let me know your feedback on this idea in the comments below. Whether you think it's interesting, if you think that Ackman might not be able to match Buffett's returns, or if you just think maybe value investing is boring. Do let me know your thoughts in the comments below. Also, if you found the video interesting, if you liked the content, then do hit like, hit subscribe. That really helps out the channel. And as always, thank you for watching.